So today's Cardinal lesson, the numbers are out for 2025. And by the numbers, I mean the tax brackets. They get adjusted for inflation every year, and it's every year. And they came out a few weeks ago, and I've got the IRS documents. The rates do not change every year. The tax rates, what changes is the brackets as they're increased for inflation. So what we're going to be talking about today is the ones that are relevant to many of our customers. So I want to put it to Tom, and I want Tom to share with us why we're doing this video today.
Yeah, we're doing this video because can be one of the most expensive costs that you have in retirement. And you need to know how these brackets work so you can properly plan for them. And through proper planning, trying to reduce that cost, those taxes that you owe. And so it's just important. And a lot of people do not understand just fundamentally how these tax brackets work. And so our goal today is really to sort of show you how these work here. And so let me bring up the show notes. These are down at the bottom of our video. There's a link below. They're also on our website. And we have the board. If you want to print it out and look at it a little more closely, you can. And then this was released by the IRS. There are 73 changes that they made for this upcoming year, 2025. And you can see if you really want to sit down and put yourself to sleep, read through all these. I certainly don't want to do that. We've highlighted some of the areas that are important that we've put back on the board here. But if you want to see where they actually, we're getting these numbers from, here is the IRS document. But just watch the video. We'll hit all the key points as we go through here.
Okay, so for 2025, just as in all other years, you have married filing joint. So a couple, they get much higher brackets when you got two people on there. And then the single rate, when you're filing single, the brackets are lower. And these rates, or the tax rates, didn't change at all, but the brackets were adjusted for inflation. So what we've done is we just put up the new brackets. Well, why does anybody care about this? Is that if you have the brackets adjusted up and your income didn't go up, you're going to pay a little less tax in 25 than you did in 24. That's not why we're doing the video. If you're in retirement and you have a little more control over your income, taxable income, than you did while you were working, meaning that if you have a big IRA or you have some IRA money, whether it's big or not, especially if you have a large one, is that you can make withdrawals from the IRA to fill up these different brackets. You say, well, why would I want to do that? Well, let's just say you were a couple and you were living off of $80,000 a year. But by the time you took the standard deduction, it's really showing up as a taxable income of $50,000 a year. And that's, if you didn't do anything, that's what you'd file as a return that shows 80, and you take the standard deduction. Actually, it's more than that if you were aged or blind or 65 or over. That's what they call, the IRS calls me, is I'm aged. So I thought that's kind of funny. But so we take this example. Well, this couple, where their taxable income is just 50 grand, they might want to take another $46,000 out of their IRA this year or during 2025, just so they finish the year with a taxable income of 96,000. So they take full advantage of the 12% federal tax bracket, okay? Or they could do a Roth conversion. So or they could sell some property and they could spread the gain over time. I mean, there's a lot of reasons people in retirement would like to know these things, or at least know that we know them if we're advising them, so that we can time certain distributions and play these brackets, in a proper way. Now, the other point that I want to make on these is that a lot of folks they look and they say, well, we do like Roth conversions up to the top of the 24% tax brackets for a lot of people. Is that people are doing that, which happens to be for a married couple, $394,000. For a single individual, it's $197,000. And that's just as simple as converting an amount in a Roth over their income to bring them right up to the top of the 24% bracket. And then, that way they're just thinking that that's acceptable now to pay at that rate, pay the taxes, and then now have the money in a tax-free account forever. So we use these charts and we use these amounts to do all that planning. The thing I wanted to make the point is this couple is really not paying 24% taxes. That's their marginal rate, but their effective rate, if they were right at 394,000, is 20%. So Tom will go over that a little bit later. So we got our married filing joint, we got our single. The standard deduction for a couple over 65 is 33,200. That's pretty substantial. So you don't itemize any deductions. You just take 33,200 off the top. It reduces tax bills and brings people down in the bracket substantially. For a single over 65, that's 15,000 plus 2,000 is 17,000 that you get to take right off your taxes without proving any of the deductions. Estates and trusts, Tom's going to go over this a little bit later, but the bracket creep happens really fast, and people get into this 35%, 37%. Not people, these are trusts and estates. So if there's a large income recognized by an estate or by a trust, the tax rates on those get up into those higher brackets very, very quickly. And so in our planning, if we're using a trust, we want to do that in such a way that we shelter income so we're not paying taxes at these high rates. Capital gains, Tom's going to go over that. There's an opportunity to pay 0% on some of the capital gains, a 0% rate. And this is something widely misunderstood. Tom's going to talk about that in a little bit. And, in last week's video, we were talking about the unified credit, almost 14 million in 2025 is what that you can have in an estate. And this is the number for 2025. You can have that in an estate and not pay any estate tax. So I want to pass it back to Tom for him to comment on what I said and maybe move around the boxes and add some points and explanation.
Yeah, and I think we'll just go sort of quickly through each box, provide a little more context. And I think one of the big misunderstandings about the whole tax code is in these first two boxes, right? The married couple and the single person. People typically know the difference there. What they don't understand is how they work, right? So I'll focus on the married couple for right now, but it works exactly the same way for the single person, just with lower numbers. Is you get to fill up those lower brackets first. And so when you start earning money, is some of that money for everybody is being taxed at 10%. Then the next money is being taxed at 12%. Then the next is 22, and so on and so forth. And so sometimes we'll get people that comes in and say, hey, I don't want to earn anymore because that's going to push me into a higher tax bracket, which that statement is true, right? The earning more could push you into a higher tax bracket, but what they miss is not all their money is being taxed at that higher tax bracket. So if you look at the effective rate, right, if we go to the top of the 24%, your effective federal tax rate is only 20%. And people say, well, wait a minute, how does that work? Well, it's because some is taxed at 10, some is taxed at 12, some's at 22, some's at 24. So when you do the math, it comes out to like 20% effective tax rate on that money, even though you filled up that marginal bracket, that 24%. And then furthermore, let's say we were doing Roth conversions and we were targeting the top of the 24% and we miscalculated and we went over by $1. We missed the threshold. We were targeting 399, 600, and then we went 399, 601. That's really not that big of a deal because it's only that $1 that's over that threshold is taxed at the next bracket, 32%. So it's really, I want you to understand that because a lot of people don't get that. And it's important to know how that works when you're doing planning like Roth conversions or trying to draw things down. We'll get to capital gains in a second, but I think that's just important. And then again, similar, it works the same way for single people, just the numbers are different. And you can see the brackets there. The standard deduction with the Tax Cut and Jobs Act, a lot more people are just taking the standard deduction because it got increased pretty significantly. And so there's not many people that are itemizing. Typically, if they're itemizing, it's because they're doing a lot of charitable giving or something like that. But other than that, there's just really not a lot of itemized deductions that most people are taking. And so if you're looking at these standard deductions, that comes off of your gross income. So another mistake I see people make when they're doing Roth conversions is they'll look at the bracket, they kind of get how that works. We're targeting the 24% or the 22 or whatever the number is for your case, and they do a gross income of that number, which I think at some level it's safe to do that. You're not going to exceed it, but you're leaving some money on the table because the tax brackets are really based off your taxable income, not your gross income. Taxable income is after you take the standard deduction. And so when you're doing things like Roth conversions, you need to factor in the standard deduction piece of it to make sure you're properly calculating all of that. And so that's just something that I think is important to look at. And then, like Hans had mentioned, if you're blind or what the IRS calls aged, but essentially if you're over 65 or older, you get even a higher standard deduction. I think that's helpful there. And so it's nice to be able to reduce your income by that. And then we have a lot of people, maybe they're not doing Roth conversions or they've stopped doing the Roth conversions. They have Social Security and then they have maybe a pension or some IRA distributions. They could be in very low tax brackets. This video, we're not going to get into how Social Security is taxed, but it's based off your other income, and so when you work through all the math and then you include the standard deduction, there's a lot of retirees that pay very little in federal tax, especially if they don't have these large IRA balances, or maybe they've already done the Roth conversions to get those lower, is you can be, in really, really low effective tax rates because the standard deduction is so high. So I think it's just important to understand that. The estate tax, or not the estate tax, but it's the taxes that estates have to pay. If you open an estate and it take a while to settle, you're having to pay, that estate is having to pay taxes. But really where this comes into play is trust. A lot of times people have seen an attorney and they've set up a trust for them, which trusts are not evil. They're not bad. They have their role. They can do a lot of really good things when necessary. But if you're doing it trying to think you're saving on taxes is one of the benefits, unless it's a really specific type of trust and you're doing other planning there, it's really not going to save you in taxes in any way. Because if you look at these brackets, you get to the 37% tax bracket of an income of just over $15,500. That is you get to that highest bracket very quickly inside trust, which is one of the big reasons that we don't recommend people leave their beneficiaries on their IRAs as trusts, because unless the trust is set up properly and all the language is correct, which a lot of times it's not, that trust inherits the IRA. It's having to pay tax on the RMDs, the income coming out of the IRAs, at these trust tax rates. You've just sent a whole lot of money to the IRS or the state government because you've left it improperly into a trust as opposed to just naming an individual person. And so that's not to say that we never recommend that. Again, there's reasons to do it. It needs to be a really good reason. But oftentimes we're trying to keep people from leaving trusts as beneficiaries of IRAs. And so that's sort of that box there. Capital gains. And so we're going to spend a little bit of time here because I see this misunderstood all the time. And so people look at this bracket, it seems fairly straightforward. I have these capital gains rates. If between 0 and 96,000 if I'm married, it's a 0% capital gains rate. What a lot of people read that as is, okay, if my capital gains is under $96,000, then I always pay 0% on that capital gains. That's not how that bracket works. And so what that 96,000 is driven by your income, which is on the front of your 1040, but you got to include the capital gains along with your other income. So if I'm making IRA distributions, if I'm still working, if I have a pension, all of that income gets added to what my capital gain is to determine where I fall on these numbers. And then only the capital gains piece of it is taxed at like the 15%, 0%, 20%. But it's not, the capital gains itself is not the only number they're looking at when they're looking at these brackets. I can't tell you how many people I've had come in. They have plenty of other income. They're still working and they're selling stocks that have capital gains. And they say, oh, I'm keeping my capital gains below $96,000. And it's like, well, that's great. And they say, I pay 0% on that. And it's like, I have to explain to them, no, that's not how that works. unfortunately, sometimes people get this advice from their investment advisor or someone who is like helping them with this, which is unfortunate because it's really, you need to be able to understand how this when you're recommending selling stuff. But oftentimes they're just getting bad advice. And so I just want to point that out because you need to know how those the capital gains brackets works specifically. And we did last week's video on the unified tax credit. I don't have a lot to add there. But again, right now it's a very high limit. This is what is subject to estate taxes. So upon your death and you're passing it to the next generation, do you have to pay federal estate taxes? Right now, the exclusion is almost $14 million. Not a lot of people are subject to this. But if you are, that rate is like 40% right now, which is a pretty hefty bill to pay the IRS upon your passing. And so just be aware of that number.
Okay. So within the scope of the 7 worries and comprehensive planning, today we've talked about 401k IRA in terms of recognizing income in a given year. We've talked about income. We talked about estate, but it's been mostly taxes. What we're talking about is tax bracket management, tax bracket planning. So with that being said, I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
We thank you very much for listening.
Thank you.